economy is going to be bigger than our economy, even though they're going to be poorer than us on a per capita basis. There's just a lot of people in China. So the fact that they're catching up, it's like being the person of the year. It doesn't mean you're the best, most fabulous person of the year. It means you're the one that's the pivotal. And it's your decision, you know, that's the one that people watch. A lot of the incremental demand in the world is coming from China. Look, whether or not, the big question is whether the U.S. is going to grow at 2.75% or 3.75% on our size of economy. In China, an economy that's, depending on how confident you are on the metric, maybe 80%, maybe 100% the size of American economy, there the question is whether it's going to grow at 5% or 9%, or 4% and 9%. That is a much bigger question with a lot more consequence to growth in the world, incremental GDP in the world. And just to make this clear, any time that somebody is growing in the world, it's good for everybody in the world. Obviously, it's great for the country in which the growth is occurring, but it inures to the benefit of everyone, because that incremental growth will result in incremental demand, which actually will draw support exports by other players as well.
Let me ask you a question about corporate America. You spend a lot of time with corporate clients who are thinking about what to do, and we often say that companies are sitting on a lot of cash, and they're not investing in capital, and they're not investing in jobs, and what are they doing? They're pursuing buybacks. How are we supposed to think about buybacks? Are buybacks a good thing or a bad thing, or are they artificially propping up the stock market?
Well, I don't think they're I mean, people are making decisions incrementally, whether it's better to invest in, you know, whether the returns are better to augment your business, but people end up with more capital than they could apply in their business. So sometimes it's quite sensible. Just to take your predicate for a second of the question, I don't think that's all that companies are doing. They're investing in making their businesses more efficient. They're not, now, by the way, efficiency sometimes could be the enemy of maximizing the labor force. A lot of the investment that's being done, you know, kind of what goes along with the efficient economy and the sharing economy and investment in technology, is the capital you're spending is getting a return for the capital. It's not augmenting labor. In fact, your efficiencies are coming at the expense of labor. And that's creating all sorts of residual problems in the country. But that doesn't mean companies are not doing a lot.
How much do you worry about that? The technology labor transition issue, which is what I think you're referring to.
I think we have to adapt to it. I would no sooner want to bar it or regret it than I would, curse the tides or gravity or some natural evolutionary force. Things are going, history is filled with people trying to hold back progress. I consider the efficiency, the creation of new technologies, I consider that advancement. I just think we need new ways of deploying labor from industries where they're less needed into activities and services where they're more needed and where they get paid for doing it.
You just got me thinking about Uber. You guys, I think, are working with Uber to invest in Uber. Is that a company that you think, it's an extraordinary growth company at a $40 billion valuation? Do those things make sense to you?
Well, I'm going to avoid talking about a specific company and just talk about the nature of the companies, that are kind of in that space. Yeah, they can. Phenomenal growth rates. They really are generating wealth. Now, you can look at the social aspect of that and say they're creating wealth because of savings that are going by making people work at such a level of efficiency that you need fewer people.
Right.
And so if somebody has a $20 billion valuation...
Fewer people and lower labor costs.
Lower labor costs, well, sometimes, and sometimes some people are making more. But if you look at it and you say, who's getting that $20 billion? It's not going to labor. That $20 billion, which is a saving of what otherwise would have inured to labor, is attaching itself to the people who put up the capital to build the company we're talking about. And so all of a sudden you have a wealth creation, because maybe that $20 billion, some of that is wealth created, but some of it is wealth that's steered away from labor in aggregate to become a return on capital, i.e. the people who invested in the new technologies. And so you're seeing a little bit of a tension between capital and labor that I think is fueling people's anxiety and feeling of wealth discrepancy.
Right. Mergers and acquisitions, this is a deal book conference. You guys do deals.
Yeah, from time to time.
From time to time. Do you think of deal making, and we are now back at a height, we have surpassed in terms of the number of transactions volume where we were in 2007.
Yeah, which is not necessarily the bar we're always seeking to.
Well, and that's the question. Is that a barometer? Is that a barometer of the market? Is that a barometer of confidence? What do you think of that as?
Well, the market issues are obviously provide a context. Higher, equity prices, low financing costs, and by the way, the feeling and the anxiety, the financing costs are about to get higher. Also, if you thought they were going to stay low forever, that's one thing that's not in a deflationary mode, the cost of money. So the anxiety that rates are going to be higher can also fuel things that could be done at any time to be done today. That's why a little bit of inflation is better than a little bit of deflation. But you have to look at it as a burst of confidence on the one hand, and a feeling that coffers are full, strategies have been formed, but have bbeen in abeyance for a while. Money is accumulated. I'd say the activists and shareholders in general, and let's not call them activists. Most shareholders are activists now, or attached to activists now, and support that kind of activity. They're expecting more. Nobody wants CEOs to have an easy life, and they're clamoring. I think it's gotten to the point where CEOs don't have to go to their boards and say, this is why I want to do something. You have to defend yourself against the charge that you're not doing enough.
Do you think that activism is a good thing for the markets?
I think everything. Are
these guys short? Is it a short-term game? Is it a long-term game? When you look at a situation where it doesn't go well, do you say that democracy is just faulty? I mean, how do you?
Look, there are some things that should be run in a town hall, in a Vermont town hall, and you couldn't run the entire government like that on every issue. Then you have representative democracy. So these things sometimes are good, and sometimes aren't as good. I would say the movement towards more activism has been picked up and supported by I would say, traditional, long-term, conservative, historically management supportive institutional investors, and I think that is good evidence of the fact that the spur and the provocation of activists are appreciated by the market and do good. Could they go further and could it become backbending and be a negative? Of course it can, and in some cases has.
Let me flip it around. What do you think of companies, and I'm thinking of Alibaba, you helped take them public, who have governance structures that effectively keep the founders in control and don't effectively allow the type of democracy that we've been talking about in the boardroom?
New York Times?
New York Times is one of them. Touche. Let me go in a different direction on you for a second. Is Arthur still here? No, he's not here. We talked to the Treasury Secretary a bit about inversions in this Burger King situation. Do you think that inversions are unpatriotic?
I think talking about, there's famous quotes. I went to law school. I studied tax law. I was a tax lawyer for 5 years before I went over to this side. I say this famous quote that it's not even a patriotic duty to maximize your taxes. I think people in the official sector have said this, predominantly what needs to be done is the tax law has to be written in a way that it doesn't stimulate the kind of behavior that you would like to avoid. That's how it is. It's people who manage companies my shareholders aren't just American. More than half my activity is outside the United States. I can't even tell you what percentage of my shareholder base is outside the United States. Probably a lot of it. People are charged with not evading tax, but appropriately organizing your affairs to avoid taxes.
But organizing your affairs to a mailbox doesn't feel as good as if you had a real headquarters. That's one thing. Do you look at it as a distinction or no?
Of course, there's a border that's in there somewhere. There's a point at which, when you, and I have no specifics in mind, but there's doctrines within the tax law that says if you organize your affairs in such a way that there's no economic purpose other than tax, then the taxing authorities can look through that and get at the economic reality of a deal. Those tools are there right now to do that. But you'd really want to have more certainty. But the idea of telling somebody, you should go, left will cost you more, right will cost you left, it's your patriotic duty to go left, and you think, that's a weird situation to get into.
Okay, let me ask you about something else.
But by the way, that kind of pressure is a fact of life that bears on people who run companies, because who run companies in the world. I'm not saying it's not a real pressure and it should be dismissed, but I think that it shouldn't be what's relied upon to steer behavior.
Let me ask you about this, and it relates to the inversions because it came after the Antonio Weiss situation and all of this. The AFL-CIO, I wrote about this, sent letters to all the banks, including yours, about the idea that certain executives on their way out of leaving Wall Street onto Washington have been able to keep or get bonuses that they otherwise would have given up had they gone to a rival or retired or what have you.
Right.
Goldman Sachs, I don't need to say, has had lots of people, has a long tradition of executives going to Washington. Do you have a problem with it?
Do I have a problem with people being made to surrender the accumulated wealth the wealth they'd accumulated throughout their business career in order to have the privilege of serving the country? Is that the question?
That's one way to put it.
I would say the reason why you let people take their compensation out is so that you, and again, what people have is, the clamoring on bonuses. People should be required to be paid in stock. That stock should be forward stock that doesn't vest for a real long time, so that at any given moment, anybody who works on Wall Street has a lot of the income they earn for years and years and years accumulated in unvested stock. In order to take a public sector job, you have to relieve yourself of that conflict, so that stock has to be abandoned or it has to be vested and allowed to be sold. Now, it's hard enough to contemplate going through the process and what one has to do to serve the public, including the sacrifice of a big income in a lot of cases. And so generally, if you say you can't vest someone's stock, but it has to be abandoned, that's a backdoor way of saying you don't want anybody from these businesses to ever go into public
But there's a lot
service.
of other businesses where people end up having to, where the bonus doesn't exist, that opportunity doesn't exist, and there are people who will tell you, and I, by the way, as you know, because I've written about it, I happen to agree with you, but I'll take the other side of it, which is to say that the public looks at it and thinks there is a bribe going on. They think that there's something amiss. I mean, there are people who have that view. You've heard that before. I'm not the first person to say that. You're looking at me like I'm crazy.
That's to me is like lower energy prices is bad for the economy. It just doesn't compute for me.
It doesn't.
Anyway,
it doesn't.
It doesn't resonate. But anyway.
But to the idea that this is public service, and that if you have to give up a little bit of something on your way to public service, you should give it up.
Well, you have to think of the interaction of the clamoring for people in finance to be paid in stock that vests over a very long period. So more of it is coming in that form for a longer period. People are giving up a substantial amount of the accumulated earnings of the prior years. It just, you're really asking somebody for a lot to do that. Some people will do it, but why does the country benefited from making something that's hard so much harder? What's the advantage of it? For what purpose?
Okay, let me ask you a separate Washington question then. I hear that Rand Paul is coming to visit Goldman Sachs next week, and you've had a lot of different potential candidates come through to meet with different people.
We have a speaker program. We also had 2 weeks ago, we had the Cardinal in and Derek Jeter.
I think Ted Cruz came too.
Ted Cruz came.
Ted Cruz came. Who are you supporting?
Derek Jeter.
You've historically supported Democrats. Where are you on Hillary Clinton? Hillary Clinton has obviously had a connection with your firm through 10,000 Women and all sorts of other things.
Well, she had a connection to the firm in that she was the New York senator, and so from time to time we, she was a policymaker and represented the people of New York, for which we're an important industry. I've always been a fan of Hillary Clinton.
Is it a liability that she has a relationship with Wall Street?
No, I mean, no, I think it's a virtue to have a relationship with a lot of institutions and a lot of parts of society. I would say if you put in the word excessively bound, I could agree with you. But I think what's happening now, there's now a litmus that if you have a relationship with anyone from this sector, and by the way, in a different era, it might be the military. If you touch, I remember when I was young and out of school, if you touched the military in any way, that was such a big pejorative. You couldn't imagine that now in a post 9/11 era, but in a post Vietnam era, if you touched anybody who had a connection to the military, that was a litmus that you couldn't, that was bad. Energy. If you touched energy, right now it's Wall Street, and I think that's a very dangerous place to be. I think people in political life should be a bridge among all these different groups. It's certainly no virtue. I certainly don't think it's a virtue to declare something, a big segment of the economy off limits.
We have a couple of minutes. Why don't we try to open it up and take a couple questions from the audience if we can? We really have to keep it tight. Jeff Sonnenfeld is in the front row. Why don't we give him the mic?
Hey, Jeff, how are you?
From Yale.
Lloyd, how are you?
Good.
Lloyd, 16 years ago, you guys led the largest IPO, talking about deals, in U.S. history at that time. And
Remind me, what was it 16 years ago?
it was your IPO.
Oh, our IPO.
Yeah.
Okay, I remember.
Well, it was easy. Nobody else would forget it.
15 years ago. But
Well, 6 months later, 2009, right? It was May 2009?
99.
99, yeah. That was,
Let me check my watch. 14. Okay.
Yeah, okay, 14 years ago. But, UPS, I think 6 months after that, caught up with you guys and beat you, but you're still top 10. A lot of people were skeptical that you and UPS, as the world's largest partnerships, would be able to retain a partnership culture.
That is Lloyd.
You got very little.
That is Lloyd Blankfein with Andrew Sorkin, talking about what he calls above-trend growth in the U.S. economy, talking about low oil prices. In his words, Europe should be ecstatic about that, saying that low oil prices being bad for the U.S. economy to him just does not compute. And then a nice line on the data coming out of China, Sarah.
Yeah, he was asked whether he believes it,
He
and
says,
he said,
do I believe the numbers? I believe there are numbers.
yeah, nice way to punt on that question. But it was a wide-ranging interview. They covered the economy. They covered some of the macro data. I think one of the key quotes you said was that Europe should be ecstatic over this oil move. And he just doesn't get the argument that the drop in oil is bad for the U.S. economy. It's something we've heard from Larry Fink of BlackRock. I mean, it's something we've heard from so many of these CEOs, not to mention Jack Lew, the Treasury Secretary, earlier this morning.
Yeah. Well, I mean, Blankfein going along the argument that many have also made. It's a huge tax cut for the American consumer, and there are many who obviously believe it will result in much higher GDP next year if we maintain these levels where we hit $60.09 a barrel.
Yeah, now with the oil's flat and energy is actually a leader in this market rebound, which we're seeing, by the way. The Dow up 170 points, S&P having a nice 1% move. Looks like we're not going to see that 4 days in a row of declines if we can continue in this strength.
Still early. Not even an hour into trading.
Well, it is a big day here at the New York Stock Exchange, one of the year's hottest tech IPOs set to make its debut, Lending Club. And as we can see from early indications, we haven't seen a trade yet, but it is looking like it is pricing above the expected range. Bob Pisani is on the floor in a sea of red jackets this morning with the very latest on how Lending Club is set to open. Bob?
And the indications right now, 21 to 23. That's quite a change. Remember, just a few days ago, the indications for the price talk was $10 to $14, $10 to $12. It was up there to 12 to 14. It priced last night at $15. 15. Right now, the indication is 21 to 23. You might wonder, why are we waiting so long for it to open? Well, because there's a lot of demand. This is a very simple process. It's a very public auction. So the lead book runner here is Morgan Stanley. Morgan Stanley is assembling a book. They have 58 million shares that they have sold, them and Goldman Sachs and Credit Suisse, to various individuals and corporations, institutions. They are going to be allowed to start selling those shares this morning. They are putting together a book indicating how much demand there is for the number of people who want to sell shares and the number of people who want to buy it. It's very simple. Right at the opening, you get one price. Everyone gets one price. When there's a lot of demand suddenly, it takes a little longer. And that's what's happening right now. Morgan Stanley, the lead book runner, is over there with Barclays, and they're trying to get indication of where they might open. Right now, it's 21. They just bumped it up, right? Just as I'm standing here, to $22 to $24 right now. And you can see various officials standing over there. I don't know, Scott, if you can show Renaud Laplanche is over there, the CEO of Lending Club. He's standing right next to Tom Farley. Tom Farley is the CEO of the New York Stock Exchange, the head of the New York Stock Exchange, president of New York Stock Exchange. And of course, he's standing there discussing what's going on. Interesting about this, first big peer-to-peer lending company to go public. There'll be another one that's going next week, but this is largely peer-to-peer lending on consumer loans. So individuals who might have very high credit card debt can consolidate that credit card debt. Maybe it's at 14, 16%, consolidate it and sell it to investors through Lending Club for maybe 7%, 8%. It depends upon the risk profile. Again, waiting for this to open, 22 to 24, pricing at 15. Guys, back to you.
Yeah, big test for the industry. Thanks a lot. We'll continue to check in with you. Bob Bassani, pretty strong day to go public for Lending Club, awaiting that first trade. As we can see, markets are certainly in rally mode, with the Dow up 1%, S&P 500 up more, and the NASDAQ up 1.3%. We'll talk about what's driving these markets in rebound mode. And later, Ray Dalio will be speaking at the Deal Book Conference with Andrew. We will, of course, take you there live. Walk on the Street. We'll be right back.